Imagine returning to that image of the American credit system in 2026 as a city of skyscrapers built during an era when cement was cheap and everyone believed the weather would stay calm forever. The skyline still looks impressive from a distance. GDP numbers are not disastrous. Stock indices have not crashed every week, and unemployment is not yet at crisis levels. But if you walk closer, through the streets at the base of those towers, the mood is different. You meet families juggling 3 or 4 credit cards, a car loan, a mortgage, and maybe a lingering student loan, all in a world where interest on plastic now routinely sits above 20%. You meet small business owners whose lines of credit are being quietly tightened, landlords told that their buildings are worth much less than they were 5 years ago, and mid-level employees whose bonuses have vanished because their employers face rising interest costs. The credit system is not collapsing in a single dramatic moment. It is straining, creaking, forcing millions of small adjustments that together create the conditions for what people call the American credit crisis of 2026, a potential domino effect that, if triggered, could shake the entire structure. Start with households, because in the United States, consumption is the main engine of the economy. For many Americans, the story of the last 15 years has been a story of normalization of debt. A young couple graduating in the early 2010s might have started adult life already owing tens of thousands in student loans, then added an auto loan to commute to work, then finally stretched to buy a house at historically low mortgage rates, often below 3%. Credit cards filled the gaps between paychecks and larger financial goals. When interest rates were near zero, the system encouraged this behavior. Banks and fintech firms flooded people with card offers, buy now, pay later options, and pre-approved credit lines. By the mid-2020s, total household debt had climbed to levels never seen before in absolute terms, with credit card balances alone crossing well above the $1 trillion mark. Higher income households might keep paying comfortably, but for many in the lower 60 or 70% of the income distribution, servicing this pile of obligations means that a huge share of each paycheck goes out the door the moment it arrives. A useful way to feel this is to picture someone earning a fairly typical middle-class salary, say $55,000, $65,000 a year. On paper, this person is not poor, yet they may be paying $1,400 a month for a modest mortgage, $450 for a car loan on a vehicle bought at inflated pandemic-era prices, $300, $400 in minimum payments across 3 credit cards, plus utilities, healthcare premiums, childcare, groceries, and gas. When one card reaches its limit, another fills the gap. At interest rates north of 20%, carrying a balance is not just an inconvenience, it is a drain that compounds relentlessly. A brief period of unemployment, a medical emergency with a high deductible, or a divorce can tip this household from managing to sliding behind. Late fees appear, minimum payments jump, and suddenly the person who was dutifully paying everything on time starts to miss 1 or 2 bills. Multiply this story by millions and a statistical trend emerges. Delinquencies creep upward from very low levels, and more people fall into collections. What makes 2026 delicate is that many of the cushions that helped households in the early 2020s have thinned out. During the pandemic, stimulus checks and enhanced unemployment benefits allowed Americans to build savings. At the same time, lockdowns limited spending on travel and services, so bank accounts briefly swelled. For a few years, households could use those cushions to keep paying rising rents and loans, even as inflation bit into their wages. By the middle of the decade, however, the extra cash has largely been spent. The bottom half of the population in particular holds very little in reserve, maybe a few $100s for emergencies, sometimes less. That means any tightening in credit conditions, lower card limits, stricter underwriting, higher minimum payments translates quickly into real cuts in spending, which in turn affects the businesses that depend on that spending. Now zoom out from the individual household and walk into a bank's risk department, where analysts stare at screens full of data about these borrowers. They see millions of accounts still current, default rates not yet exploding, and a labour market that, while cooling, is not in free fall. On the other side of the ledger, they also see warning lights, more customers revolving balances for longer, falling savings rates, and signs that lower income borrowers are under increasing stress. Risk officers start to adjust policies. Maybe they approve fewer borderline applicants. Maybe they quietly close inactive accounts or reduce limits on customers whose scores have slipped. None of these decisions make headlines, but taken together, they define the availability of credit in day-to-day life. For consumers already living close to the edge, a cut in available credit can be as painful as an outright job loss. Move up a layer in the skyscraper city and you reach the floors occupied by commercial real estate, offices, shopping centers, warehouses, hotels, and apartment complexes. This is where the notion of a refinancing wall becomes central to the 2026 story. When interest rates were low, developers and landlords borrowed aggressively to buy and build properties, often using debt with maturities of 5 to 7 years. Many of those loans were structured on the assumption that at maturity they would simply be refinanced on similar or better terms. No one imagined that within a few years, demand for office space in many downtowns would collapse due to remote work, or that central banks would raise rates at the fastest pace in decades. Yet that is exactly what happened. As 2025 turned into 2026, hundreds of billions of dollars in commercial real estate loans began to come due each year. Some properties, especially warehouses, logistics hubs, and well-located apartments, could handle higher interest costs because underlying cash flows remained strong. But a large stock of older office towers, secondary malls, and marginal hotels faced a cruel arithmetic: lower rents, higher vacancies, and much more expensive debt. Consider a simple example. An office building downtown was financed with a $100 million loan at 3% interest in 2019, costing $3 million a year in interest. The property's rental income after expenses might be $6 million, leaving a comfortable cushion. Fast forward to 2026. Hybrid work has taken hold. Occupancy is only 60%. Tenants have negotiated lower rents. Net income drops to, say, $3.5 million. The loan now needs to be refinanced, but market rates imply something closer to 6 or 7%. At 6%, interest costs become $6 million a year, more than the building's income. Lenders look at these numbers and hesitate. They may demand that the owner pay down a chunk of the principal, bring in fresh equity, or accept a much smaller loan. The owner, perhaps a real estate fund with investors expecting returns, may decide it is cheaper to default than to pour new money into a losing asset. When that happens at scale, banks and other lenders end up with buildings they do not want, marked down from the valuations they use to report healthy balance sheets. For regional and community banks with concentrated exposure to local commercial property, a wave of such revaluations and defaults can be dangerous. Even if regulations require capital buffers, the market's perception of their stability can shift quickly once losses are disclosed. Depositors may move funds to larger institutions. Funding costs rise. Managers react by pulling back on new lending to other sectors, including small businesses, residential developers, and consumers. This is how trouble in one corner of the credit universe, office towers in a handful of downtowns, can start knocking down the next row of dominoes. Parallel to real estate is the universe of corporate credit, the bonds and loans that fund companies ranging from stable blue-chip manufacturers to speculative technology startups. During the era of cheap money, many corporations refinanced old debt, issued new bonds, and loaded up their balance sheets. Some used the proceeds productively, investing in research, capacity, or digital transformation. Others engaged in aggressive share buybacks or acquisitions at frothy valuations. In both cases, the crucial assumption was that servicing this larger stock of debt would remain affordable. When central banks lifted rates and credit conditions tightened, that assumption became shakier. Well-capitalized, profitable firms can still borrow, though at higher rates. But weaker companies, that is, those with thin profit margins, cyclical revenues, or business models that never fully worked, face a much tougher environment in 2026. Imagine a mid-sized company in a cyclical industry like retail, fashion, or construction equipment. During boom years, it issued bonds at 4%, rolled them over easily, and used bank lines to smooth its cash flow. As sales slow, profit margins compress from, say, 10% to 5%. At the same time, new debt now costs 7 or 8%, and banks scrutinize every extension of credit. To meet interest payments, the firm cuts investment, freezes hiring, and delays paying suppliers. If recessionary conditions deepen, revenue falls further, turning that 5% margin into a loss. At some point, management faces a choice between restructuring its debt, begging lenders for more time, or entering bankruptcy. As defaults rise in these kinds of names, investors who hold portfolios of lower-rated bonds and leveraged loans see their assets marked down and their confidence shaken. Some begin to pull money from funds they perceive as risky, forcing managers to sell what they can. That often means dumping higher-quality liquid assets first, which spreads pressure into parts of the market that were not directly involved in the original problems. Floating above all these private sector debt stories is the colossal figure of public debt. The US government has accumulated a stock of obligations so large that, for many ordinary people, the numbers have lost meaning. Yet the underlying logic is straightforward. Every year that the government spends more than it collects in taxes, it must borrow the difference by issuing bonds. For many years, the combination of low interest rates and strong global demand for safe dollar assets made this borrowing relatively painless. The cost of servicing the debt, even as the principal grew, stayed manageable. As rates rose and deficits remained wide, that comfort faded. Interest now claims a bigger slice of the federal budget, crowding out other priorities or forcing ever more borrowing to cover past borrowing. In a benign scenario, the economy grows faster than the interest burden, and the ratio of debt to GDP stabilizes. In a less friendly scenario, investors begin to question whether they are being adequately compensated for holding so much US debt, especially in a world of political polarization, frequent fiscal standoffs, and demographic pressures on social programs. Financial markets translate these doubts into yields. If investors demand higher yields to hold treasuries, the benchmark for almost all other borrowing in the economy shifts upward. That means mortgages, car loans, corporate bonds, and municipal debt all become more expensive at the same time. The irony is that public debt, which is often described as the safest asset in the system, can become a channel through which stress propagates. A sharp move higher in yields can destabilize institutions that hold these bonds on a leveraged basis, as was seen in the United Kingdom's pension turmoil in 2022. In a 2026 American context, a similar shock could force large holders of treasuries and other long-duration assets to adjust portfolios rapidly, crystallizing losses and adding a new row of dominoes to the pattern. To understand why all of this is described as a domino effect rather than a single earthquake, it helps to think about timing and feedback loops. The system does not break everywhere at once. Instead, stress appears at the edges. A rise in subprime auto loan delinquencies, a spate of smaller office building defaults, a pickup in bankruptcies among highly leveraged companies. At first, these are framed as contained problems. Banks book some provisions and reassure investors. Policymakers point to aggregate data that still look acceptable. Markets oscillate but do not collapse. Yet beneath the surface, the behaviors of key actors are changing. Lenders become more cautious, borrowers become more defensive, households cut back on non-essentials, companies scale back investment plans. Each micro-decision, rational on its own, quietly reduces the flow of credit and spending. An everyday illustration can be found in small towns far from Wall Street. Picture a community where a regional bank has historically financed local businesses, developers, and home buyers. The bank holds a portfolio of loans on strip malls and small office buildings that are now struggling with lower occupancy. As appraisals come in lower and borrowers ask for extensions, the bank's leadership decides it can no longer afford to grow its book aggressively. It raises lending standards, declines more applications, and shortens terms. A local restaurant that wanted to expand decides against it after the bank offers a smaller line than requested. A contractor delays hiring apprentices because a project's financing falls through. High school graduates, seeing fewer opportunities, move away. House prices stagnate or fall slightly. None of these events by itself is dramatic enough to land on a national front page, but together they illustrate how a credit squeeze translates into slower growth, less dynamism, and greater social strain. At the same time, memories of past crises shape expectations. Many adults in 2026 lived through the 2008 global financial crisis and the pandemic shock of 2020. They remember how quickly jobs vanished and asset prices fell. That history can make both borrowers and lenders jumpy. If rumors spread about a particular bank's health, about an investment fund's exposure, or about government plans to cut benefits, people may react preemptively, withdrawing deposits, selling assets, or cutting spending. In an interconnected system, fear can become its own kind of contagion, pushing otherwise manageable problems over the edge. Yet it would be misleading to present this as a simple story of inevitable collapse. The same system that looks fragile also contains shock absorbers and fire breaks built over years of reforms. Banks today, especially the largest ones, generally carry more capital than they did before 2008. Regulatory stress tests force them to model very severe downturns and hold buffers accordingly. Derivative markets, where many of the hidden risks lay in the last major crisis, are more centralized and more transparent in key segments. Central banks have standing mechanisms to inject liquidity when markets seize, and governments have shown a growing willingness to launch targeted support programs when entire sectors come under strain, as happened with airlines and small businesses during the pandemic. These features do not eliminate the risk of a domino effect, but they can slow it down, redirect it, or break it into smaller cascades. Another moderating factor is the uneven distribution of risk and resilience. Not all households are over-leveraged, not all office buildings are empty, and not all companies are drowning in debt. Many families use the cheap money era to refinance into stable, low-rate mortgages, locking in predictable housing costs for decades. A significant slice of the population holds little or no credit card debt, maintaining high credit scores and access to cheaper borrowing. Some cities have successfully repurposed older commercial buildings into residential or mixed-use projects, softening the blow from changing work patterns. Certain sectors, such as healthcare, some areas of technology, and parts of the energy transition, may continue to grow even in a broader slowdown, providing pockets of employment and investment. This patchwork of vulnerability and strength means that while a national narrative of crisis may take hold, the actual experience on the ground will vary widely. Still, for a video exploring the American credit crisis of 2026 as a potential system-threatening domino effect, the crucial thread is how interconnected these layers are. A heavily indebted consumer base makes the economy more sensitive to shocks. A refinancing wall in commercial real estate amplifies the impact of higher interest rates. Corporate borrowers at the edge of solvency turn a mild downturn into a wave of defaults that hits investors and banks. A large, persistent public deficit financed at rising interest rates limits the government's room to respond without stoking new worries about debt sustainability. Each of these elements could be handled in isolation. The concern is that under the wrong combination of events, say a global slowdown, a domestic political crisis, and a sudden loss of market confidence, they might reinforce one another instead. In this sense, the domino effect is less a prediction than a warning framework. It invites viewers to think about sequences. If this happens, what comes next? If consumers pull back, which companies suffer first? If a string of regional banks falters, what does that mean for local economies and for national lending standards? If bond markets demand higher yields from the US, government, how do households and firms cope with borrowing costs that refuse to fall even in recession? By walking through these chains carefully, using concrete stories of households, businesses, and communities, an audience can see how what looks like a remote issue of credit markets is actually woven into their everyday lives. It is the interest on their credit card, the value of their home, the stability of their employer, the taxes they pay, and the social safety nets they rely on. Ultimately, the American credit crisis of 2026, whether it fully materializes or remains a near miss, is a test of how a mature, highly financialized economy copes with the end of an era of ultra-cheap money. It is a test of whether safeguards built after past disasters are enough to prevent a new systemic breakdown, and whether policymakers can act swiftly and coherently in an environment of political division and global uncertainty. The skyscraper city of credit may stand, though with some damaged towers and forced demolitions. Or a single toppled row of dominoes, perhaps in an overlooked corner like a mid-tier bank's commercial real estate book or a shadow banking vehicle stuffed with risky loans, could set off a chain reaction that proves much harder to stop. For anyone watching in 2026, the key is not to fixate on one dramatic moment, but to notice how small cracks in many places can add up to a decisive shift in the system as a whole.